Hello everybody. So this video is boldly titled Stretch versus TLT, question mark gold in TLT versus MSTR and BTC. And another thought that comes to mind as I make this video is, how dare I make this comparison? Because trending on X today is people rejoicing, TradFi rejoicing about TLT breaking $90. It even held it for a few minutes, breaking into the $90. And of course, X is calling for a whopping return. We're going to move from $90 to $100, right? So outstanding return, more than 10% return you can expect perhaps within the next few months. And TradFi is now yelling, gold has run so much as a risk-off asset. Why don't you rotate from gold, which is one safe haven asset, one risk-off asset, to the ultimate risk-off asset? What is this ultimate risk-off asset? It is TLT. It is government bonds. TLT is, of course, an instrument that owns a whole bunch of government bonds with different interest rates, different kind. It's like a hodgepodge of different bonds from the government, and it yields a whopping 4.43% taxable, right? It's not a return of capital like Stretch. It's a taxable 4.43. So how dare I even compare instruments of the future in the matter of credit, such as Stretch, such as MSTR, such as Bitcoin, instruments of the future in terms of capital and where capital is headed? How dare I compare it to TLT, who today broke $90 again? This is something worth celebrating. Anyways, this is all about a guessing game, folks. This is all about the guessing game. The short-term market is about guessing what the boomers will do. What are the boomers going to do? What are those that are not on X? What are those that are on ivory tower who control capital for others? What are hedge funds in ivory towers? What are those who have been in the field for 40 years and have become myopic to new ideas, entrenched thinking? What are they going to do? This has been the market for the past 3 months, 4 months. It's about guessing what the normie, what the TradFi folks will think, what they will think. And here is what they often think. It's like, okay, well, bonds are risk-free. It's the risk-free rate. It's what I learned in my MBA in 1974. The risk-free rate. And also gold is a safe haven, but gold has moved a lot. So time for me to move from GLD to TLT. And of course, all of these short-term strategies, I mean, in my view, you're not even going to beat the S&P. Being cute with all of these cute strategies, running away from the volatility, running away from the future. How are you even going to beat the S&P if you're considering gold, if you're considering TLT, either of them, when they come into consideration? How are you going to beat even the S&P? And again, how dare I showing some facts, and these charts, frankly, are pretty cruel. They're pretty damning for the TLT. So this is TLT against QQQ. As you know, my favorite index is the QQQ. I don't consider the S&P 500 to be a legitimate index anymore because it is run by a committee of boomers who are not future-oriented. Cue in how late they got Tesla in, cue in how late they will be to add strategy. The S&P 500, as far as I'm concerned, has lost credibility. QQQ has not, because QQQ is only rules-based. It's just the biggest market caps on the NASDAQ. The 100 stocks with the biggest market caps on the NASDAQ. That's what the QQQ is. Market cap weighted, no committee, and therefore no bias, which is why the QQQ, as far as I'm concerned, is the risk-free rate of return, not the S&P. The QQQ is the risk-free rate of return because the S&P is adjusted towards lower returns because of a committee who takes into consideration things that ought not be taken into consideration, right? Like how many models of cars does Tesla have? Right, that was a consideration to keep Tesla out of S&P for years and years and years. Anyways, let's look TLT versus QQQ. Oh boy, this is very cruel, right? From 2002 to 2026, TLT did not return 4%. It returned 3.8% in an era for which, half, like until the 2010s, in monetary inflation was probably 8%, 7 to 8%. After the 2010s, in my view, that monetary inflation was much higher than 10%. As you know, on this channel, I consider inflation, monetary inflation, right? The speed at which they print the dollars, not inflation, the CPI, not the vector of politically decided categories which you may or may not buy, but I'm talking about the monetary inflation rate, right? To me, it's 15%. So QQQ, as far as I'm concerned, has kept up. QQQ has kept up with inflation. TLT has not. TLT has not, because the CPI is not real inflation. The CPI downplays inflation tremendously. But let's continue with the cruelty. I feel bad because if you think this is bad performance of TLT against QQQ, I really feel bad because let's compare TLT to Bitcoin, right? TLT to GBTC. That's the topic of this video, comparing TLT to Bitcoin, right? So TLT to GBTC, we are looking at, of course, we have to go back to where Bitcoin was, quote unquote, publicly traded, which is GBTC. That's when Bitcoin was available. So we have to go back to 2015. TLT since 2015, so for nearly 11 years, TLT has returned 0.23%. I'm going to round it to zero. It has returned zero. In an era where money inflation was 15%. In an era where the hurdle rate was 15%, TLT returned zero. GBTC returned 54%. 54% ARR for nearly 11 years. And of course, if you compare GBTC to gold, right, Bitcoin, widely accepted as digital gold, Bitcoin returned still 54%. Gold returned shy of 14, under 14%. Let's round it up to 14. 14% against 54%. So we're not even in the same league. This is not even the same league. The TradFi is debating assets that literally do not matter compared to where we're headed in the future. They are debating assets that don't matter compared to where we're headed and where the long-term investor is headed and where the future is headed. So again, how dare I, right? How dare I show up the long-term charts of comparisons? How dare I? But I'm going to keep daring and talking about how the facts have changed, because this is a problem with TradFi. This is a problem with Normie and trying to guess what Normies, TradFi's, ivory tower people think. They think bonds are risk-free. Again, MBA from 1974. But things have changed. Even the rating agencies, by the way, have downgraded US debt. But things have taken a turn for the worse for government bonds. The shutdowns are, they are not a good thing. These shutdowns are not a good thing. Is the new average 3 government shutdowns a year? Is that the new average? So last October 2025, we had the longest shutdown, and then we had a short shutdown at the end of January. And we kind of have a situation right now with DHS in the Senate and the House, and that may lead to another shutdown, perhaps before the midterms. And I didn't quite find the betting odds on that, but if I were a betting man, I would say there's likely going to be another shutdown before the midterms. So does government debt that is threatened to not be paid, to have a coupon missing, you miss a coupon, does government debt with missing coupons, is that a threat now going forward 3 times a year? Again, I don't think the bonds have sold off like they should have. They should have sold off much more. Also, we are closing in on a political campaign, political election. To me, the $1 trillion platinum coin is going to make a comeback. They do it for the clicks. Senators in the House, in the Senate, senators in the Senate, representatives in the House, do it for the click. Put a committee together and talk about $1 trillion coin. This is going to come back. This, in fact, in my view, is going to come back probably every 2 years. This is going to come back. Is that a threat to the value of the dollar whenever you have a committee in Congress who says it's a good idea to start thinking about printing $1 trillion coin out of thin air? This is something Bitcoiners have been keenly aware of and following, but one day it might happen, and that could be a really, really big deal. Unless, of course, you have a compliant Fed who drops the rates to zero and just prints anyways, which is likely going to happen. But you could have both. You could have interest rates at zero, and you could have Congress who decides to go ahead with $1 trillion coins, and then, why print just one, right? You could print a few of those. To quote Elon Musk, and that was now more than 2 years ago, "We'll see how risk-free it really is." And then he proceeded to chuckle on the conference call. This was Elon Musk replying to an analyst's question about all of the bonds that they held at Tesla. Even Elon Musk is aware of that, right? And that's why, of course, Tesla owns a sizable bag of Bitcoin, right? Tesla is still one of the top holders of Bitcoin, even though, it's not a treasury company. They still own a little bit of Bitcoin at Tesla. A little bit. Who am I kidding? They own a lot of Bitcoin compared to most treasury companies. A little bit compared to the size of Tesla. So anyways, I think companies who choose this government debt, I think it's a lot of an artifact. It's a lot of an artifact of the law, and you can't really own the debt of other companies. There's a bunch of regulations, but it's probably not by choice. And I think a lot of individual investors have a choice to pick which debt they own, and maybe debt backed by Bitcoin, maybe, just maybe, is better debt than the TLT. So there's two things, and I'm going to give a kudos to Google, because Google, and I could have put Apple's debt as very, we know Apple borrows at less than 3%, so I could have put Apple's debt in there. I'm just going to comment on Google's debt. But first, of course, this video is about Stretch, right? So Stretch. So I scrolled down, right? This does not include the converts. This is only looking at the preferreds. Let's look at the BTC rating. So, of course, Stretch, you get a variable rate, 11.25% tax-deferred return of capital. So you don't pay taxes until you got all of your money back. That's point number one. But the Stretch debt is backed by a BTC rating. And you can see the BTC rating of, actually, I got it wrong. It's actually 4.5. The BTC rating, I don't know why I put 3.7. Oh, that was strike. Okay, 4.5. Okay, the BTC rating of Stretch is 4.5x. So that means we are 4.5x the value of Bitcoin backing up Stretch. So that means that if you buy the Stretch instrument, which pays you 11% yield, if you buy that instrument, there is $450 worth of Bitcoin backing that debt, backing that instrument, right? If you buy a bond, the bond is backed by the full faith and credit of the US government. And you have to ask yourself, how much do you trust the whole shutdown shenanigans? How much do you trust that there's not going to be another proposal for $1 trillion platinum coin? These are the questions you have to ask yourself when you buy a government bond. When you buy an instrument like Stretch debt, Strategy's preferred instrument, what you have to ask yourself is the value of the Bitcoin backing that debt. How low could it possibly go? And I guess if you think Bitcoin, that $450 worth of Bitcoin, if you think it's going to be, dropping way more than 75%, then I suppose you would be a little worried. But, we're all Bitcoiners on this channel. And this is 4.5 BTC rating, so $450 worth of Bitcoin backs every $100. And I'm talking to this at a price of Bitcoin of 67,000. So this is after Bitcoin has almost experienced a 50% drawdown. So what if Bitcoin gets back to 126,000? Well, in that situation, you will have, $800 worth of BTC backing $100 worth of stretch. So that debt is in fact very, very strong. You only lend to the rich, they say. As far as I look at the BTC rating of these preferred instruments, strategy sure looks like the rich to me. Sure looks like the rich to me that I want to lend to because they have all of this Bitcoin backing it up, right? And of course, you could say, yeah, the US government has, for example, land, a bunch of federal land backing the debt, and that's entirely true, but there is a giant committee of hundreds of politicians who are, separating that coupon from that ownership of land, for example, or from that taxation, and they can't print a dollar coin, a platinum dollar coin. So, anyways, that's point number one. So debt backed by Bitcoin. If we had a lot of debt backed by gold, I would also like that better, right? Debt backed by oil, I would like better. Debt backed by gold, I like better. Debt backed by Bitcoin, I like better. And there's some debt, I suppose, which if it's backed by very powerful cash flows, I like it. For example, Google's debt, of course, is backed by cash flows so strong that they get a bid when they put out a 100-year bond. So it was actually oversubscribed up to 30 billion. I think they borrowed $30 billion. They had to oversubscribe it from 17 to 30 billion. 100-year bond Google just issued. What does that tell you? That tells you that the market is confident in the quality of the cash flows of Google, And just the fact, for example, that Google owns 7.99% of SpaceX, frankly, should give a lot of confidence to the market. But you see this like that. And, the big debate right now is government trying to raise 50-year bond. Do you think 50-year bond would have crazy demand like Google's debt has at a 100-year bond? I'm not so sure. We'll see. But if you look at the government bonds, the government has been issuing a lot of very short-term debt because, Japan's selling the bond. Russia sold the bonds a long time ago. China is selling the bonds. And I guess, unfortunately, retirees who are normies, who are not following this every day, hours a day like we do, I guess they still own the bonds in a 60-40 portfolio. And that's a tragedy, if you ask me, but that's just the way it is. So let's conclude talking about gold, because I wasn't gonna leave gold just like that. I gotta address gold too. So how dare I the final rounds of fact? Let's talk about gold. So people are upset that gold is up so much. Of course, gold is up because China has been buying up a lot of gold, and it's kind of the only asset that's like big enough. I mean, I guess they could buy US equities, but they don't want to buy US equities because, sovereignty stuff. So they've been buying a lot of gold. And of course, that's rotating away from the bonds, away from the US government bonds, rotating into gold. But here's the problem. There's many problems with gold. We know the classic argument, of course, which is once the price of gold goes up, the supply of gold also goes up because gold diggers get gold out of the ground. The Barrick Gold, all of these big companies, they start digging more gold out of the ground, right? This is the same issue as oil. For example, whenever oil goes up, you have fields that are not profitable who all of a sudden becomes profitable. And that's why at one point in Canada, you had mountains entirely being dismantled to get oil out because it was profitable to destroy the mountain to get the gold out when gold was trading at $100 a barrel, right? So the same is true about gold. If you increase the price of gold, more people will dig more gold out of the ground and more people will search of gold and you will find more gold. But by far, the biggest risk to gold is not the supply on Earth, or is not the laws of supply and demand and human labor. No, it's technology. Technology is the biggest risk to gold. So I'm not going to talk about alchemy on this channel, even though it has been done in a lab, and we've created gold in a lab. But I'm not going to talk about that. I'm going to talk about the rapid pace of technology. So in my last video, when I covered gold, I was, of course, talking about this golden nugget. I can't remember the name. I had it in my prior video, but there's an asteroid that's just outside of Mars that has 700 quintillion ounces of gold. So that would be enough gold to make everyone on Earth a billionaire. And of course, if gold is a multi-century asset, you have to assume that there's no entrepreneur who's going to get to Mars. You have to assume that there's no entrepreneur who's going to have a base on Mars. You have to assume that nobody's ever going to get to the asteroid belt. Also, please note, there are closer asteroids to Earth who are also very, very, very much full of gold. In fact, many asteroids are highly ferrous, and they are very strong in gold. The reason why gold is very scarce on Earth is because much of it is concentrated in the Earth's crust, because while Earth was being formed billions of years ago, gold was a very heavy element, and heavy elements rallied towards the center of the Earth. So gold is very high concentration in the center of the Earth, very low concentration in the crust. But of course, asteroids being so small, having such small gravity, they don't have that issue, and they are so much higher in gold, so much higher content in gold. So that's one aspect of a technological risk to gold. But the bigger technological risk, which was trending on X today, and I very much agree with it, didn't think of it like that, but I very much agree with it, humanoids are a major disruption to gold. Humanoids are a threat to gold, and they are many ways closer to us than launching, asteroid mining from the moon or from Mars. I would argue that's further away than actual bots on Earth, single-purpose bots. And so if you follow this field, which I do, I'm very passionate about this field. A lot of people, for example, are very excited about robots in agriculture, saying, well, for example, everybody's going to have a perfect front lawn because you can just have a bot remove the weeds by hand all day. And you can just have, everybody can just the most manicured yard because the bot all of a sudden can spend 10 hours just walking on your front yard, removing piece by piece, each little weed in a mechanical way, and all it costs is energy. So that's an example which I find very interesting. All of the things we're going to be able to do with those bots, and this got me thinking on X. This is really, really true. If gold price is high enough, you can just divert a robot to go search for gold. You can just divert them to go search for gold. These robots, some of the first tasks they will do are literally boring and repetitive tasks, like removing weeds by hand in the yard or cleaning the dishes. Or you could just send them in the river, and you could just have them go walk 10 hours in the river trying to look for gold. Of course, I AI generated this picture. Or you could have them on the beach with a metal detector. And of course, the bigger impact perhaps maybe in a mine. And of course, this impacts not just gold, right? This is true for precious stones, precious metals. This is true for all sorts of commodities. Once you can mass manufacture these, and once these become the cost of consumer electronics, and so that means cheaper than cars, most likely, eventually cheaper than cars, most likely, what's going to happen to any scarcity of today that can just be gotten out of the ground so easily? What's going to happen? And I think this is perhaps an even more immediate threat to the supply of gold than just prices, supply and demand dynamics, and just the regular traditional, quote unquote, traditional mines getting more gold out of the ground. So I view the movement in gold very, very, very much short term, very, very much TradFi oriented, and not technologically proof to innovation. It's not innovation proof. Bitcoin, on the other hand, was created to be innovation proof. and I've had this debate on X about the potentially potential breakage of the wallets of Bitcoin by quantum, which is still very, very theoretical. But really, even if that happened, and if those coins widely circulated, all it would create is a little more inflation in the Bitcoin network. That would be a temporary change in the price of Bitcoin, because all of a sudden the Satoshi coins would have to be distributed and they would have to be sold and etc. But you wouldn't change much about the algorithm. You would still have a 21 million cap. That's it. So that would still be short-term action. Gold, frankly, with a long enough time frame, this is inevitable. These two things are absolutely inevitable with a long enough time frame. Absolutely inevitable. In my view, and countries who are bidding up gold, they should be thinking in 100-year strands. And so if you're following technology, this is near inevitable. So anyways, that's just my take on this. So while the market is crazy wondering about the short-term stuff, I think people should be focusing on the long term. And the long term, I don't think, is going to be gold. TLT, there's a shot that TLT, if we actually got governments to be aligned, there's so many things the US could do to not do shutdowns. There's so many things the US could do to get back on track and give faith back to the dollar. So many things we could do, but this requires politicians getting along, and I'm not sure that's going to happen. If you see the fall of Rome and what happened to Rome and what happened to republics around the world, you realize that actually, republics last hundreds of years. Civilization has showed that if you want to last thousands of years, in general, it's more monarchy that can last thousands of years. So we'll see. Anyways, this was not investment advice. This is not financial advice. This is only entertainment. I hope you were entertained. Please please subscribe, follow me on Patreon, follow me on X. Thank you for watching, and have a wonderful, wonderful day.